Hey everyone, welcome back to Corporate Decoder. Today, Shimmick Corporation, SHIM, just filed an 8K announcing a stock offering, and I am seeing a clear sign of how they are funding their growth. Quick note, this is not financial advice, just my take on public filings for educational purposes. Shimmick is selling more stock to raise money, and this is a pretty common move for companies in their industry, but it does come with some important things to consider. So what is going on here is that Shimmick Corporation, a company focused on infrastructure and construction, has announced a public offering of its common stock. Think of it like this, they are selling more pieces of their company to investors to get cash. The earliest event reported here is May 22, 2026. This is when they entered into the agreement to sell these shares. The company we are talking about is Shimmick Corporation. They are publicly traded under the ticker SHIM and they are in the industrial sector, specifically engineering and construction. They have about $100 million market cap and employ roughly 971 people. You might have seen headlines recently about them raising about $14 million from a stock sale. This filing confirms that here we can see what they are offering. It is their common stock and the price per share in this offering was set at $3.50. An interesting detail is that Shimmick has elected to be considered an emerging growth company. This means they can take advantage of certain relaxed reporting requirements that allow them to potentially grow faster without being weighed down by some of the stricter regulatory burdens. It is a common strategy for younger companies. The main event here is under item 1.01, which covers the entry into a material definitive agreement. This essentially means they signed a significant contract. On May 22nd, Shimmick signed an underwriting agreement with Roth Capital Partners. LLC Roth Capital Partners acted as the underwriter, which means they helped Shimmick sell the shares to the public. They plan to sell 3730000 shares of common stock at $3.50 each. Now, part of this deal included an option for the underwriter. They had a 30-day window to buy even more shares if they wanted to, up to 559,500 additional shares. This is often called a green shoe option. And guess what? They exercised that option. The underwriter bought all those extra shares. So in total, Shimmick ended up selling 428,9500 shares. That is actually more than they initially planned. After things like fees and expenses, Shimmick raked in about $14 million from this offering. This cash infusion is crucial for a company like Shimmick, especially if they are looking to grow their operations or take on new projects. Think about it if you need to buy more equipment or hire more people, you need cash. This offering is their way of getting that cash. This amount of $14 million is significant for a company with a market cap around $145 million as of recent checks. It represents about 10% of their current market value. For comparison purposes, when electric vehicle maker Lordstown Motors conducted a similar size stock sale in late 2023, it was a material event that signaled their need for immediate capital to continue operations. While Shimmick's situation is not as dire as Lordstown's was, it highlights the importance of these capital raises for companies needing fuel for expansion or to manage cash flow. This offering was set up using something called a shelf registration statement on Form S-3. This is a process that allows companies to pre-register securities they might want to sell in the future. It makes it quicker and easier to get shares out to the market when the time is right. It was declared effective on the 10th of July 2025, meaning the CAC had already reviewed and approved it. The agreement itself has all the usual clauses. You'll find standard promises and guarantees from Shimmick conditions that must be met to close the deal, and agreements on who is responsible if something goes wrong, especially concerning the Securities Act of 1933. It also covers other commitments and ways the deal could be ended. This Exhibit 1.1 is the actual underwriting agreement itself. These agreements are pretty dense with legal jargon, but the key takeaway is that they outline the terms and conditions of this sale. Then we have Exhibit 5.1, which is an opinion from their lawyers at King & Spalding LLP. This is essentially a legal stamp of approval stating that the shares being sold are validly issued and legally sound. And conveniently, Exhibit 23.1 is the consent from those same lawyers to have their opinion included in this filing. It's common practice to include these legal opinions when issuing new securities. And finally, Exhibit 104 is the cover page information in an interactive data format, which is standard for modern SEC filings. This stock offering, raising $14 million, is a significant event for Shimmick Corporation. It is a clear indicator that they are actively seeking capital to fund their growth or manage their business operations. The fact that they sold more shares than initially offered by exercising the underwriter's option suggests there was strong demand from investors at that price point. However, issuing more stock or diluting the existing shares can be a double-edged sword for shareholders. While it provides the company with much-needed funds, It also means that each existing share represents a smaller piece of the company. If Shimmick can effectively use this new capital to drive revenue and profitability, the dilution could be well worth it in the long run. But if the money isn't used efficiently, existing shareholders could see their investment value diminished. The key question now is what Shimmick will do with this $14 million. Are they investing in new infrastructure projects, acquiring new technologies, or expanding their workforce? Their recent headlines suggest they are continuing to win projects, which is a positive sign that the capital might be well deployed. But it is always wise to watch how these funds translate into tangible business growth and financial performance in the coming quarters. If they can demonstrate strong execution and profitability from these new projects, then this stock offering will likely prove to be a smart strategic move. That is my take. Stay decoded. If you found this deep dive helpful, please like this video. Subscribe for more analysis and check out the Discord community linked in the description.